Trading is actually one of those places where the size of your account really doesn't matter. Whether you're trading with a $10, $100, $500 or $100,000, the actions are exactly the same. You analyze the chart from an idea, enter the trade, review the result, and repeat. The only difference is the number of zeros at the end of your balance. You don't even need every trade to be profitable. That's almost impossible. But in this video, I'm going to show you how to stay consistently profitable, even if only like 3-4 out of 10 trades actually make money. And no, this isn't some magic button in the exchange interface. It's 5 simple steps that have to happen strictly in this exact order. Step 1. Psychology. When the account is small, let's say 100, 300 bucks, even good trades can feel kinda pointless. You make 5% and that's just like 15 bucks. And the thought immediately coming into your head, seriously? I'm sitting here for hours staring at the charts for this? And this is where the most dangerous part for beginners begin. You start feeling the urge to make it big in one shot. You take big leverages, x50, x100, or you throw the entire account into one single trade thinking maybe this time you will get lucky and the account will double. The result is almost always the same. The account gets wiped out in 1 or maybe 2 trades. This is a classic mistake you see with a huge number of people in the market. The second common mistake is the lack of strategy. For example, today the entry based on, for example, RSI. Tomorrow it's based on some news. The day after is just a feeling because the chart kinda looks like the price might reverse. Every trade turns into kind of lottery. There is no any system and no any understanding of what actually works and what doesn't. So, how do you deal with this? Even if your account only has 100 bucks on it, treat it as seriously as possible. Imagine your trading account is a lifeboat in the ocean and every dollar is a passenger. Your job is to get that boat safely to the shore. If you overhead with risk, it's gonna sink very quickly. So the main takeaway at this stage is simple. You need strict risk management. Step 2. Risk management. Experienced traders follow a very simple rule. The risk per trade should be a maximum of 1, sometimes 2% of the whole account. For example, let's say the account is like 150 bucks. The risk per trade would be around 1.5, maybe $3. Yes, the profit will be modest. It might be like around $3 to $9, but the loss won't destroy the account either. If you get, for example, 10 losing trades in a row with a 2% risk, the account will lose around 20%. The account is still alive and you can keep trading. But if you risk, for example, 20% per trade, just 5 mistakes in a row and the balance will be almost wiped out. So the first rule is simple. One trade should never cost more than 1 to 2% of your whole account. Now the second rule. Risk to reward ratio. In every trade, you want to have at least 1 to 2 or ideally like 1 to 3. For example, if your stop loss is $2, your take profit should be at least $4 or $6. This is what makes the math work over the long run. Let's imagine, for example, 30% win rate. That means 3 winning trades out of 10. So let's calculate. 3 trades with, for example, $6 in each trade give you $18 of profit. 7 trades with a minus $2 in each trade give you like $14 of loss. The result is plus $4 after 10 trades, even though like 70% of the entire were losing. If the win rate is 50%, in this case, the growth becomes noticeable. If it's like at least 60%, the system starts working very well. And the hardest part is actually following the rules. When the price moves against the position, many people start changing the plan. Some move the stop loss further away, some close the profit too early, some add to a losing position. And at that moment, the whole math breaks. That's why both the stop loss and take profit must be defined before entering the trade. Third step, the power of compounding. When the account is small, the growth at first feels kind of slow, but over the time the effect of compounding starts to kick in. Even relatively small returns can turn into serious numbers over the long run. For example, around 1%, just 1% per week can give you roughly like 16 to 70% over a year. If we're taking about more active trading, around 15% per month is a level disciplined trader with a solid strategy can realistically reach. $100 with a 15% per month can grow to roughly like 15-16K in about 3 years. So if we look at more aggressive level, around, for example, 20% per month, which only the strongest traders manage with a higher risk, then $100 can grow to around 70 to 80K over those same 3 years. And this isn't magic, and it's not some secret signals, it's just the math of compounding. The main condition is simple: don't destroy account in the first month and give the profits time to accumulate. And by the way, if you are interested in the market analytics and real trading setups, we regularly publish them in our Telegram channel. Our team of traders shares the market analysis, trade ideas and trading signals there. Right now access is totally free, and you will find the link to the channel in the description under this video. Subscribe. Step 4. Trading strategy. Without a strategy, trading turns into a chaos. A strategy is basically a set of the rules: when to enter, when to exit, and when it's better to skip a trade. The main mistake beginners make is trying to use dozens of the different approaches at the same time. It's much better to choose one clear strategy and stick with it for a few months. For the crypto market, one of the simplest approaches is trend trading. There are two main types of entry. The first one is a trend continuation after pullback. The second one is a trend reversal. For analysis, you can use trend lines and horizontal support and resistance levels. This can be previous highs and lows, round levels, or zones where the price has reacted before. It's also important to choose a set that actually moves. Usually these are coins with a market cap above at least $100 million, good trading volume and noticeable volatility. Before trading, it's better to mark up your charts in advance on higher time frames like 4 hours or 1 day. Identify your zones of interest and wait for the price to reach them. And very useful practice is a backtesting. You should scroll back several months on the chart and see how the strategy would have performed in the past. Step 5. Trading journal. The last element that separates professionals from the most of the traders is a trading journal. Most beginners don't keep one, but professionals always do. So it can be like a very simple table: trade date, asset, position size, reason for the entry, stop loss and take profit, and of course result and comment. Over the time, this kind of journal starts revealing important things. For example, when you tend to break your rules more often after a series of winning trades or after the losses, and which setups actually work better. There is some very good examples from sports. Conor McGregor studied recording of his opponent's fights and noticed that right before throwing a strong punch, the opponent made a small movement with his hand. He prepared a counterattack and knocked him out in 13 seconds. A trader's journals works in very similar way. It shows repeating mistakes and helps you to fix them. But in the end, everything in trading comes down to just one thing: discipline. After several losing trades in a row, it's better to stop and just take a break. After a series of winning trades, it's just as important not to lose your head and start increasing your risk. If you follow these rules, even a small account can grow over the time. A very realistic scenario is 10% per month, starting with just $100. After 1 year, that's about like $314. After 2 years, it's around $1,000. After 3 years, it's roughly like $3,000. And that's the growth of more than 30 times. And if the starting account is like $500 or $1,000, the numbers become much more interesting. But the 5 key elements stay the same: psychology, 1 to 2% risk per trade, risk to reward ratio, and working strategy. And of course, trading journal. If you follow all of these consistently, a small account stops being a problem. And one more reminder, my friend: if you want to see real market breakdowns, analytics, and trading signals from our team, check out the Telegram channel linked in the description under this video. Write in the comments what amount you started trading with and what the biggest challenge is that's holding you back right now. So, trade smart, respect the risk, and I'll see you in the next video.